What up, guys? It's April 24th, and I'm back on the channel after taking some time off to myself to kind of just, just chill, relax, read some 10K reports that usually come towards the beginning of the year. And these are reports that you should be checking for each one of the stocks that you own. I have about 15 stocks. Got to read about all of the 10K reports, these annual reports that tell you everything you want to know about the business that you own, right? So let's get on with what's going on, all right, and explain to you a little bit what the deal is and what I've been missing to tell you, which is, surprisingly not much, okay? But before we do, please hit that like button, hit subscribe. Definitely appreciate all your support and you guys watching my videos while I'm taking some time off, okay? So let's get to it. All right, guys, so the last time I uploaded a video here is about a month ago, and I'm talking about being all in on this market, and nothing's changed. Nothing's really changed. I'm still all in this market. I'm dropping money on this market whenever I can, whenever I have an opportunity, and we'll talk about why I'm doing that, because it's important for you guys to understand, okay? But let's go over the charts and let's go over everything in order as we usually do, okay? Let's get on with it. So I want to give you guys this comprehensive view of the overall market and what you guys should be looking at, these indicators. So we see that essentially the Dow on Friday closed 981 points. I'm going to make that blue so you guys can see that. 981 points, pretty much 1,000 points dropped. Disaster day for the Dow. S&P dropped 121 points. That's 2.77%. Unbelievably, the NASDAQ and the Russell outperformed by a little bit. That's not saying much, but they outperformed by a little bit. VIX reaching that 28 mark, close to that 30 mark that we talked about in previous videos, on how that 30 mark is this kind of like really nice indicator as to when stocks can be and should be bought. Okay, not every time, but probably the majority of the time, to be honest. And we focus on energy too. We're focusing on that. The price of oil at $100 a barrel. Brent, that's the European oil. Natural gas is $6.42. The reason we watch energy is because the higher this price is here, the lower stocks go on all these indexes, especially probably the NASDAQ and the Russell 2000, okay? When it comes to what the other thing we're looking at is the bond yield, the interest rates. We're looking at the 10-year bond yield to look at what interest rates are doing. And they've kind of flirted around this high twos area, close to 3%, and probably will go higher. And we'll talk about that as well, okay? So the indicators that we're watching for is the price of energy and bond yields, to show you kind of what the action is and what the market is doing. The higher they go, the lower these guys will go, okay? That's essentially what we're looking at as far as the overall market indicators. Now, for tomorrow's action, here's the pre-market numbers. This is the futures market for tomorrow, and we're seeing here that the markets are down for tomorrow. Again, not significantly, got 0.5% moves on the Dow and the S&P, also NASDAQ. And no Russell 2K there because it doesn't have that, okay? But the price of oil still at 100, a little bit lower than what we saw on Friday, and the 10-year bond yield just a little tiny bit lower. So these are not significant moves. I wouldn't make anything of this. This is not like an indicator of what you should do or not as far as the futures market, but it does kind of tell you where the market is trending after 3 o'clock on Sunday, when the future action begins. Now, one of the things to consider is that we're coming into this busy earnings week moving forward. Let me pull that calendar out for you guys because it's something we have to consider. Earnings are the primary driver of value in the stock market, okay? We can listen to all these technical indicators and what the bond yields, what the price of energy is doing, what the Federal Reserve wants to do with interest rates. We can watch that all day long, but if your companies do not report good earnings, they're going to get crushed, no matter how good or bad these indicators are, okay? So let's go over that real quick. So here it is, guys. Busy week ahead for earnings. And we're watching different companies here because, of course, like I've said this before, to watch the news and how the economy's doing, and to watch, CNN, Fox, whatever you want to do to see the economy's doing, you're not going to get a clear picture. It's just not going to happen. Okay, what you're going to do to know how the economy is doing and what the consumer is doing is looking at these companies right here. And what the CEOs are telling you, what numbers are reporting, are they lower, are they higher? Is demand increasing, is demand decreasing? So we're watching things like Coca-Cola, right? Coca-Cola is going to tell us how the consumer is doing, especially when they're going to restaurants, going to fast food places. Are their sales up? Are their sales down, right? We're looking at things like Activision Blizzard to get a good idea on gaming. There's been a lot of doubt on gaming lately and the strength of gaming and how weakened it's become. If you have any questions about that, look at the price of AMD, Advanced Micro Devices. It's been demolished recently, mainly because of a belief that there's a weakness going on in the gaming industry as far as sales. So we'll watch Activision Blizzard to see what they say there, okay? In addition to that, nothing else here interests me. For Monday, maybe Whirlpool is one, but we know that housing, and this has mostly to do with housing rather than strength of the consumer, and I don't foresee these guys having a good number on Monday, but we'll see. That'd be nice to hear what they have to say, okay? Now, before the open Tuesday, we got UPS. Very, very important to listen to UPS. They got a great CEO, Carol Tomé, who will tell you how the economy is doing as she sees it. No sugarcoating, nothing like that. She was the ex-CEO of Home Depot, brought Home Depot to a whole new level. So she's one of those legendary CEOs that you need to watch out to for what she says. There's this shift in the consumer from online shopping into retail, kind of like brick and mortar retail. This is going to be a very telling indicator on how that shift of the consumer is going from online to brick and mortar retail. Now, an interesting one here is Raytheon, and I'll tell you why Raytheon is an interesting one is because, of course, everybody knows about the war in Ukraine, but these guys are makers of the Javelin missile, and of course, everybody that watches the news and the conflict knows that they've been selling a ton of Javelin missiles to Ukraine. This is kind of like their lifeline as far as winning the war and trying to kill tanks, kill helicopters, kill planes. The Javelin missile, and these guys are the makers of the Javelin missile. I kind of foresee a good number there. I'm really interested to hear what Raytheon has to say, and it doesn't trade at a big valuation, in my opinion. So, very interested to see what they have to say there. Now, if you're interested in housing, I think Waste Management and D.R. Horton are going to be very interesting for you to hear as far as the housing sector and how that's going, which is not good, right? Everybody knows to buy a house, not good. To sell a house, probably not that good either. Even though if you want to sell it, you're probably going to get a really good price, but at the same time, it's kind of like, where do you go if you sell your home? So if you're not one of these people that owns 3, 4, 5 houses, then you go to sell your house, where are you going to go? You're just going to go to another expensive home. So it's hard to kind of take that decision nowadays, okay? Now, of course, we have the big dogs reporting here, Microsoft and Alphabet, at the close on Tuesday, okay? Microsoft is going to report good numbers. I don't fear bad numbers from Microsoft unless their cloud business is affected. Their Azure cloud business, you have to watch out for that. I'll probably be listening to that call after the close, okay? Alphabet, of course, this is a good take on what Meta is going to do, right? Facebook. So Alphabet and Meta are sort of in the same business of advertising, right? So when it comes to advertising, this is a name that's been hit, right? But not as much as Meta. We'll talk about Meta in a minute, but we want to hear what they say here as far as advertising numbers and YouTube numbers, okay? Then we have Visa. Visa is a good indicator for how PayPal is going to do. So we got to watch that as well. We own PayPal for the account. And then General Motors as well, a competitor to Ford. We want to see what they say, even though I'm not too concerned if GM reports a bad number versus Ford. The numbers are not going to be good. They're not selling a lot of cars. I don't think it's going to be anything other than we're not selling a lot of cars. We're not making a lot of money. But it's about the future with these two. And I believe in the future of Ford a lot more than the future of General Motors. I think Ford is better ran than General Motors, okay? And Chipotle's one that I think is going to be very good. It's been hit pretty recently, and I think that the valuation will start to make sense, but it's a high multiple. It's one of these blue chip stocks that is one of the best restaurant fast food kind of stocks that you can buy. Chipotle, it just carries a big premium on the share price, on the face value of share price. But again, that doesn't matter. The face value of his stock doesn't matter. Now we move on to QuantumScape. I think this is one of these electric battery makers. I'd kind of be interested to see what they have to say as far as the supply for batteries and kind of like the chemicals and all the minerals that go in the batteries. I'd be kind of interested to see what they have to say there. Other than that, nothing else there. And then nothing here that really interests me. And then we move on to Meta. Okay, Meta is a name. And let me pull up the valuation on Meta real quick so you guys can see and the chart. So here we go, guys. Here's the chart of Meta and the statistics behind it. You guys can see that on a 1 year, if we put up a 1 year chart of Meta, this thing has been completely demolished from Meta. But what you have to understand about Meta is that right now it's trading at a ridiculously cheap valuation. We're talking about 13 times earnings, and on a forward PE basis, let's pull that up, the forward PE. We're looking at a 14 and a half for forward PE on Meta platforms. And I think that's just ridiculously cheap for this company, but of course it doesn't come without issues. Remember, we used to hold this company. We held it for a little bit under a year until they reported earnings, and we heard on those earnings that they expected a slowdown on the business, a slowdown in subscriber growth. And we heard that, and we sold the stock because they warned us ahead of time that this was going to happen. We sold it at about 326. The high is about 380. Yeah, 384 on the high for Meta. So we sold it about 326 after it got that hit after reporting bad earnings. But you listen to the conference call and you hear them telling you, hey, we're going to slow down. So that's why we pulled the trigger. We sold. We took that profit. It turned out to be a good decision to take that profit. But now at 184, you have to consider buying Meta Platforms for the long term. I mean, there's just a lot of good there, and subscriber growth is not going to be a thing, but the market panics in stocks like this, kind of like on a Netflix, which I'll talk about in a little bit. When a stock trades on subscriber growth, kind of like a Meta Platform or a Netflix, and it stops reporting subscriber growth, how do you value the stock? This is why people panic. And people panic sell the stock because they don't understand anymore. How do you value this? So Meta has to go through this kind of revaluation process. And I'd be very interested to see this in the 160s, 170s. I'd like to see it under 175 personally for me to start picking it back up slowly and kind of patiently, because I think this gets back to a dominance of the ad revenue space, of virtual reality, which I'm very interested in, the metaverse. That's a long play. That's a long kind of theory of how that plays out over the next 5 years. So I see it more of a 5 to 10 year play than anything else. But when it sells at a valuation of 13 times earnings, I'm very interested. So consider me very interested in Meta. And if it sees more weakness, I might start a position there again. Now moving on to PayPal. We own PayPal for the account, and it's been a big loser of ours recently. Remember, we had our last video. If you want to go to my channel, my last video on PayPal, we talked about the changes. We talked about their divestiture or their separation with with eBay. That's what it's called. Their separation with eBay, and how that's going to play out more into Q3, Q4 of this year. So PayPal is one that I've been buying. I've been buying more heavily. Probably DraftKings is the more heavy. Number 2 would be PayPal as far as heavy buys recently. So I'm going to keep buying PayPal. This is a payments giant. I see this in 3 years going back to 200. No problem. So why not buy some PayPal shares at this valuation? I mean, the valuation is pretty enticing at this point for such a good grower and such a great technology that PayPal brings for payment services. And then moving on to Ford. So like I was saying, Ford, we're not expecting these immense numbers from Ford. We're not expecting beats. We're not expecting much of what's going on with the ICE business, the internal combustion engine business, to actually do good. I think the Ford Maverick is amazing. It's an amazing vehicle. It's probably selling well, but at the same time, supply chain issues are going to be a bbig deal. I don't see these guys selling a ton of cars, kind of like a Tesla is. And even Tesla reported a great number, great amount of sales, great profits, expanding margins, and the market didn't care. The market did not care about that because that's not what the market is focused on, okay? So when it comes to Ford, I'm definitely looking to pick up shares, but under my cost basis of about $12.80. So not interested in picking up Ford right now, maybe when it's a little bit cheaper, because we love their electric lineup and we think the future is very bright for Ford. But that's probably towards the end of this year, mid-2023, okay? And that's what we're holding these shares for. Now moving on, Qualcomm is one that I'm always interested in. This is a very, very cheap stock at the moment. I mean, let's look at the valuation of Qualcomm real quick. So you see, we're looking at Qualcomm at a face value of 132, right? You're buying this company at $150 billion with a forward PE of 11. That's dirt cheap for a semiconductor name like Qualcomm. I think that is dirt cheap. It's under the trailing PE, which is what we want. Price to sales of 4, reasonable. Price to book is a little bit high, but at the same time, this is my favorite measurement. 11 times forward earnings, I think, is very, very reasonable for Qualcomm to start a position there. I would have no doubts, no issues starting a position. However, we already hold NXP and Marvell Technologies, which I think are higher growers than Qualcomm, so that's why we hold those. Now, moving on, Teladoc Health is another one we're watching on Wednesday. We like Teladoc Health. We own it for the account. This is a long-term 3-year plan for Teladoc. We're still adding shares and reducing our cost basis. We have about 95 shares at about $88. It's trading at about $58, $59, $60 a share right now. Totally okay being down on Teladoc. This is going to be one of these winners out of the lockdown periods, out of the Rona periods, and still growing. And I think the market's not gonna realize that it's still gonna be a growth kind of company moving forward. It trades at a decent valuation, in my opinion. It trades at the same valuation that it was trading before the lockdowns and before the Rona was a thing, which I think is ridiculous, but whatever. We'll hold it. We're totally fine reducing our cost basis there and being patient with Teladoc Health. Now, get your popcorn out for Thursday Twitter before they open. And if you're listening to this call, maybe this is why they put it at 5:30 in the morning or 5 in the morning for before they open, because they know that if they do this in the afternoon, they're going to have the whole world listening to this call. So most people don't get up at 5 in the morning to listen to conference calls. Very smart of them to do this so they don't get all this press right away and it hits so hard, because there's this whole Elon Musk thing going on. Everybody kind of knows about it. So very smart of them to do a 5:30 a.m. release for Twitter, okay? Now, nothing else really interesting here. Maybe Caterpillar is interesting if you want to know about the strength of building around the world and around building supplies and building machines around the world. This is a good indicator of economies and growth in economies, Caterpillar. And then nothing else here interests me for the rest of the day. Of course, Amazon and Apple. This is going to be huge, guys, because if Amazon or Apple reports a bad number, or let's talk about it this way. Let's talk about Apple first. If Apple reports a someone in line number or disappointing number, the market is getting hit big time, okay? Because we're talking about pin action. Apple moves the market. It's a $3 trillion business, or a little bit, probably $3 trillion or below. And if that takes a 10% hit, it takes down the market with it, because all these ETFs, all these hedge funds that have money here are going to be shuffling money around if they think that Apple is not doing well. Hopefully not. I think Apple, as usual, reports a good number, reports a good subscriber growth, great revenues for iPhones and how their cycles go with technology. So I'm not worried about that. I am more worried about Amazon, however, because Amazon is a higher multiple tech name, essentially, cloud name, tech name, e-commerce. So the market right now hates high multiple stocks. If Amazon does not report a good number, a killer number, just a kind of like, that's what was expected number or below the expectation, it's going to get hammered. No way to think about around that. If you look at Shopify, you'll see that stock having dropped from like the 1200s into the $400, $500 range. It's lost a lot of value. Amazon, the same thing could happen there. Okay, now Roku is another one that felt the action from Netflix and the negative action there, so that's one that we stay away from. Don't care about that. And Intel, a competitor to Marvell, AMD, we'll definitely be hearing about that. Nothing else here, guys, interests me for the rest of the week as far as earnings go. Okay, so let's go over what's going on with the market. What's the deal with this market, and kind of what the juice is, what's flowing around in the news and in the market, and what people are talking about, real investors are talking about, okay? So the first thing I'm going to talk about is overall bearish sentiment. So if you go to our Stock Letters Discord, or pretty much any kind of, news site, or, CNBC, or Fox Business, there's an overall bearish sentiment on this market, meaning that the market doesn't have any legs which it can stand and run on. There's no good news really in this market that we can price in and take us higher. What is out there, if you think about it this way, what is out there that makes you confident that this market can get back to all-time highs? And I don't know of anything that can get us back to all-time highs. Of course, this is not going to last. All these bad things aren't going to last, but you have to think about what are the good things that are driving us forward, and there's a lot more bad than good. So the overall bearish sentiment has a huge deal to do. Now, moving on, the Federal Reserve, okay? We're talking about the Federal Reserve fighting inflation, quantitative tightening. That's the QT. You're going to hear that word a lot in the next coming months, okay? That demand destruction that quantitative tightening causes. So when you think about demand destruction in the Federal Reserve is actually trying to decrease your demand for products, specifically housing, cars, everything that's causing inflation at the moment. So if you look at the consumer price index, the producer price index, that is what the Federal Reserve is targeting, those high causes of inflation. So we're talking about energy, we're talking about used cars, we're talking about rental vehicles, we're talking about loans, right? We're talking about the liquidity of the system. So the Federal Reserve is trying to undercut that with higher interest rates. If higher interest rates are higher, it's harder for you to get a loan. It's more expensive for you to pay for that loan. It's more expensive to get a car, to get a home, right? We need the housing market to cool off. So this is what the Federal Reserve is doing. They are causing on purpose demand destruction so the prices can come down. I really think that they need to do this to some extent because I think high prices resolve themselves over time. So low prices and high prices do that. They just resolve themselves over time. But of course, we need a little bit of a helpful push here from the Federal Reserve. I hope that they do a good job. I think so far they've been doing an okay job on it. A lot of people say they're behind the curve. I really don't believe that. I think they're looking at data and reacting to that data. Okay, now moving on. The soft landing narrative. Okay, the soft landing narrative talks about the equation or the kind of balancing act that the Federal Reserve has to do to kind of have the economy land softly due to higher interest rates and let us kind of level off for a bit and then take back off and show some growth on the economy after high prices and inflation have been kind of, wrestled down. So that's something that you're going to hear about is that soft landing narrative over and over again. We'll see how that pans out. Okay. Now, the war in Ukraine and energy costs, of course, that's still ongoing. This is why I still have the mic here with a Ukrainian flag. Support of these guys. I mean, I hope I've told you guys before, I think that if it was up to me, I'd be out there fighting and volunteering. But I have a family kid, so I can't do that. But of course, the way we talk about the Ukraine war is not about my desire to do A or B. It's about energy costs and the supply of energy because Russia, being the gas station of Europe, is done. That's closed. So it causes volatility in energy prices, meaning that inflation goes higher and the cost of living is higher, specifically for those in Europe, more than here in the U.S. Now we talk about ongoing supply chain disruptions, guys. That's still ongoing. This hasn't changed since I've stopped doing videos for about a month. It hasn't changed at all. And especially when we have the Chinese, the PRC, People's Republic of China, zero tolerance for the Rona and lockdowns. That affects supply chain because it means there's less goods coming overseas. Less goods means more demand, less supply, higher prices, more inflation, right? Now, bad earnings numbers and pin action. Let's talk about that for a second. And let's talk about it in the way of the end of Netflix and chill. And let me talk about that for a minute. And here we go, guys. Here's a chart of Netflix for you guys to see. And when I talk about the end of Netflix and chill, I mean it. So we look at a 5-year chart of Netflix, and we can see that you're buying Netflix today. If you're buying it, I don't recommend that, but if you're buying it at about the same price it was 3 years ago. At about the same price. So this is what I'm talking about when a stock trades on a specific metric, like subscriber growth. And Netflix all of a sudden stops growing subscriber base and loses its subscriber base to the tune of 200,000 subscribers over 1 quarter. What do you do? How do you value a stock that no longer has subscriber growth when the only measure of its price was based on subscriber growth? Guess what happens? The market panics. People panic. They go, how do we value this? What do? We got to sell it because we don't know what it's worth now. We don't know why it's worth $95 billion today. Nobody knows whether Netflix is worth $95 billion today or it should be worth less or more. Like, what's the new measure of valuing this company? Is it the EPS, $11 a share, or $11 per share of EPS? How do you value it? So the market has to take a breath in, sell the stock, and kind of find a new bottom for the stock. I'm not sure if it's done finding a bottom. I think that the market first has to decide, how do we want to value Netflix and on what metrics do we value Netflix? Right now it's being priced like a tech name and with a PE of 20, and let's check out the forward PE. Let's check that out. Forward PE of 19, still a little bit pricey for this market, okay? Anything over 15 in a higher interest rate in a quantitative tightening environment, anything higher than a 15, it's pretty high. It's pretty high priced already. So the higher the interest rates go, the higher the tougher the valuation metrics is or are on the price to earnings ratio. Let me know if you guys have any questions about that. Okay. Okay, so we talked about the end of Netflix and chill. Banks underperforming last week. Banks reported the big banks underperform. They have a lot of bond obligations that get more expensive as the price of bonds go higher, and they're not having the credit card loan growth, the checking account growth that we'd like to see. Of course, banks make more money as interest rates go higher, but if that's offset by their bond exposure, then that's a problem. So we're looking at actually regional banks outperforming. So if you want to hold a bank, I would recommend regional banks rather than the big banks like the JP Morgans, Bank of America. Maybe Bank of America is okay, but Wells Fargo, don't touch those yet until they report that they're less levered to their bonds, okay, and more exposed to higher interest rates, kind of like your regional banks, okay. And moving on, we're going to go to the market hates high multiple tech stocks. This is because of higher interest rates and quantitative tightening. The more tightening you get in the economy by the Fed, the harsher valuations you're going to get on tech names, high multiple tech names. This is why I say that when we look at Amazon, and here's the valuation measures for Amazon, when it's trading at 52 times forward earnings, and we're in a quantitative tightening situation, if Amazon does not report a stellar beat over their Q1, over the year-over-year numbers, Q1 2021 numbers, you're going to see this stock get demolished by the market, the same way Tesla reported that. Let's take a look at Tesla here real quick. Check out this chart of Tesla, guys. This tells it all. Here, reports earnings here on Thursday, and then the market goes, yay, amazing earnings. I mean, the earnings were amazing, but when you're a stock that trades at 200 times earnings, 200 and a forward price to earnings ratio of 88 in a quantitative tightening environment, what do you think is going to happen, right? What do you think is going to happen? So this is what we see Tesla essentially do on a 5-day chart, do nothing after report stellar earnings, right? Increase sales, expanding margins, all the good things you want to hear from a stock, essentially nothing, right? Nothing happens. So that's why you have to be careful in these quantitative tightening environments. You have to pick up stocks that have been severely demolished, not stocks that have been doing great and kind of maintaining their outperformance. So to try to close it out, because I've already gone way far here, is a recession priced into these markets? So when we talk about all these bad things and whether they're priced into the market, right? Nobody really knows if they're priced into the markets, right? I think that quantitative tightening is priced into the market to some extent. I think that a recession is starting to be priced in by the markets to some extent. And all these things essentially are priced into the market to some extent, but you do not know where the bottom is. And I'll bring you guys to my last point. Essentially, what do you do with this stuff? Let's go over that. So in looking at this market, I want you to ask yourself different questions. I'll set up different questions, very easy questions to understand, okay? So are there reasons to sell your stocks, okay? And when you look at the stocks that you hold in your portfolio, you have to look at them and go, what is my reason to sell the stock if I'm panicking, if I believe that I can get it at a better price later on, if I believe that I can sell now and buy cheaper later, which you may or may not. If you're that good, please call me. Please send me a message. If you're that good in which you say, I'm going to nail this bottom of this market, I'm pretty sure, I'm 99% sure that you are not going to nail the bottom of this market. I'm not either, but that's okay because we don't play that game of going in and out of stocks and getting them for cheaper and selling them bigger. We don't play that game. We're investing in businesses. So is there a good reason to sell your stock? Is there a fundamental problem with the company that you hold? You have to ask yourself that. And you have to ask, are we facing a systematic risk to the economy, to the overall economy? If you're in this camp that you're saying, hey, I think a recession is coming, and we're not going to be able to avoid a recession, then you have to look at the overall economy. Go out in the economy. If you're going to a restaurant, is that restaurant really like not doing well? Like, is it begging for customers, or is the restaurant full? Is it serving too many people with not enough staff? is the demand for its services not there? If you go to the mall, if you go shopping at the mall, do you see a very few amount of people, or do you see a lot of people still shopping? And I think you'd be surprised to see that there's still a lot of people shopping. I go out there to the economy and I watch different things, levels of traffic, right? Levels of people at the mall, of restaurants, of people shopping at Best Buy, at Home Depot. And I do not see this dropout. I see people shopping at Target. I still see plenty of people shopping and spending money. I think the consumer is still strong. So as far as a systematic risk, I don't see it. I just don't see it, guys. Now, moving on here, valuations, do they make sense to you? And I'll tell you this much. Valuations are at all-time lows, and you will probably never again, unless there's some kind of cataclysmic event or something that's unforeseen that we don't see in our wall of worry, these are the best prices in stocks you probably will ever see in your lifetime. DraftKings selling at $14 a share near its IPO price. You may never see that again. This is the reason it's my number one added stock lately, because I think in 3 years, what does it matter if you pick up DraftKings at 14, 15, 16, 17, and it's going to be $100 stock in 3 years? What does it matter? So ask yourself this: Am I really trying to just nail the bottom, which I may not nail, and just try to be like this, like expert trader, and trying to hope that I sell things and buy things at the right times and time this market correctly? You're probably not going to do that. So ask yourself: Does it matter that I'm buying, Disney at 124 instead of 119? Does it really matter? And the answer is probably no. It doesn't matter in the long term. So ask yourself those questions on valuation, okay? And when do you pull the trigger to sell, right? Is it too late to sell? Are you going to sell DraftKings at $14 a share? Are you? Are you going to sell Disney at 118 when it's pretty much giving you Disney Plus for free? It's trading at the same price before Disney Plus was a thing. So does it make sense to sell Disney because it went down 4 points? I don't think so. And at the end, when do you pull the trigger to buy? And my answer is now and moving forward. If you're not in this market, good for you, because now it's time to get in. If you're one of these people that are on the sidelines, I don't know what you're waiting for to get in this market. I am all in this market and dumping more money as I get it. I don't have unlimited funds, but whenever I can, I'm dumping money into my account and buying shares of companies that have been destroyed, that have great futures, that are going to do good in the next 2 to 3 years and are going to be leaders in their sectors. So that's it for today, guys. That's all I want to go over. Like I said, I'm back. Whatever you guys need, I'm still posting on Instagram. I'm still doing everything. I'm still in this market 100%. Whatever you need, let me know. Hopefully you learned something, had some fun. We'll see you guys later, okay? Peace out.